we're dealing with two things. One is just that if you really think about it, if I had said 13 months ago that we would be sitting here today and the Fed would have hiked 500 basis points in 9 months, plus or minus, you would have thought it was crazy. So we're sort of like coming into this phase of sobriety, trying to figure out how do we all do our jobs differently, and what does it mean for the investments that we've already put in the ground? And for me personally, I think the setup is that it amplifies tail risk. And so right now, I'm sort of somewhat quite cautious because I think there's a left tail risk, and I think Mike Wilson is here, but if you listen to Mike, who's been really right so far, the risk is that the S&P earnings are sort of with a one handle, 180, 185, and all of a sudden the S&P is 3,200, 3,300. But then there's this right tail risk, which is that the Fed becomes dovish, everybody capitulates because it looks like things are slowing down. And now all of a sudden, though, you will have to deal with terminal rates that are going to be 4 to 5% on a more consistent basis, because if he lets off the gas now, then inflation kind of sticks around.
Hey guys, welcome back to Library of Wealth. Today we have venture capitalist Chamath discussing the current economic climate, as well as the Federal Reserve's unexpected hike in interest rates, which has caused investors to reevaluate their long-term strategies. He also highlights the challenges of investing in growth companies and the private markets, and identifies 2 levels of risk which could lead to repriced assets. While he's cautious about the potential consequences of these risks, he believes that a high-rate environment could benefit certain sectors of the market and force better management and more efficiently run businesses. Let's get right into the latest interview with Chamath as he gives his market outlook for 2023 and what his investment strategy is for this year. Don't forget to hit the like button and subscribe to the channel if you enjoy the content we do here. Let's get right into the video.
In our industry, there's a couple of dirty little secrets, or like the dirty soft underbelly. One of them is that only 10% of all of the firms in our asset class actually generate real returns. 10%, which means 90% are basically floundering around burning money. The other thing is that we have always consistently generated a high single-digit DPI, so like 1.7x is like the 30-year average on distributions. Yet we are the worst offender when it comes to showing people, like you guys, paper markups or TVPI. There's a lot to learn when you look at the past, which is that a high-rate environment, at least in the area in which I operate, which is technology businesses, we've actually counterintuitively built better businesses during periods of high rates. Yeah. And the reason is because there are fewer allocators that come to our part of the market, because you can find better risk-free rates, as you said, the 2-year, even down to T-bills and repo, quite honestly. So that's one thing. And then the second thing is that in the absence of this surfeit of capital, it forces each individual company to frankly just be better managed because there's less money. And so we become, as an ecosystem, more intolerant of excess. And all of that just creates better run businesses. And so we haven't had that cycle for probably 14 or 15 years. And so we desperately need it, because if you look inside of a lot of technology companies, they're unfortunately rotting from the inside out, right? They've had a period where they've been able to raise successive amounts of capital to fund a valuation creep that frankly won't translate into what the actual money is you're going to get back. There is this dance that this industry has been able to play because rates have been at zero. So as investors, the asset class, I think, is very challenged in order to generate real returns now. The companies that we funded have, as a result of all this excess capital, been more poorly run than otherwise. And so we need to course correct. So we need these rates to be sustained for 5, 6, 7 years, frankly, hopefully, in order to really flush it through the system.
Chamath notes that the technology industry has not experienced a cycle of high rates in over a decade, and believes this is necessary to correct the excess and valuation creep that has taken place. He notes that only 10% of firms in the industry generate real returns, with the majority floundering and burning money. This has sustained high rates for 5 to 7 years and could help flush out the system.
I think the problem with growth investing, just to give you some anecdotal data, like at the end of last year, I looked at 6, 7 converts. And these were all extremely well-known companies that all of you would know on a first name basis, and they all came to me trying to raise convert. And I said, well, here's the real market clearing price of these companies, and none of them took my money. And instead they did a convert to basically deflect and kick the can down the road on valuation. So we're in that point in the market where all the boards of these private companies refuse to budge on valuation. And the reason is because it impacts meaningfully their DPI or their TVPIs that they've given to LPs. And so it's a very difficult part of the private markets right now to invest in, because you will not be allowed to do true price discovery because nobody wants to take the real hits. The best companies will do it. I mean, I think you saw today that Stripe may take a 50% down round. That's probably the best technology company in Silicon Valley proper being built right now. So they'll do it. Klarna did it. In fact, it's so interesting that it's all, the through line there is Sequoia, which is an extremely disciplined and incredible organization, so they're able to enforce that discipline. But other companies, other venture funds, they don't want to look at the TVPI decay. And so it's uninvestable, quite honestly. On the other end, early stage venture has always been where the real gross dollar profits are made. And if you overlay that with a rising rate environment and you regress that back 30 or 40 years, in fact, we did it looking back 60 years, the most incredible opportunities to make money are actually when rates are rising in early stage venture. That's just the historical artifact if you look at public companies in size. So, we said very explicitly, okay, no more growth. The default answer right now is going to be no, we're not going to touch it, but we're going to continue to sort of over-index into early stage and do as many good deals as we can see and, let the chips fall where they may. Right now today you can generate using solar and wind energy that's effectively approaching zero. And it's cheaper than nat gas. And it's not just at the residential level, but it's also at the baseload power generation level. And so as a totality, you have the ability for 100 million US homeowners to effectively displace 1,700 utilities and all of that monopolistic behavior and regulatory capture. And so if all of a sudden you have free, abundant energy that you can collect from the sky and store in your garage and direct anywhere you want, you all of a sudden have the ability to solve problems via brute force that before you couldn't because they were boundaries of energy. Separately, we have found a way to transition Moore's law away from CPUs into these application-specific chipsets now that operate in a realm of machine learning and AI.
Chamath believes that two intersecting technological advancements will be transformational for society. The first is the increasing ability to generate solar and wind energy at a cost approaching zero. He believes it'll allow for the displacement of utilities and solve problems that were previously impossible due to energy limitations. The second advancement is the transition away from Moore's law towards the realm of machine learning and AI. Chamath believes that the cost of this technology is approaching zero as well, and when combined with the decreasing cost of energy, it'll allow for tackling previously difficult problems. Chamath's approach to the current market is to focus on early-stage ventures and find companies that play on the themes of renewable energy and machine learning AI. What do you think about Chamath's economic outlook for 2023? And what's next for these rapidly growing sectors we're seeing now? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.